Assalamualaikum, we are from Group 6. We will present about Enron accounting scandal.
Before we begin our documentation, I would like to introduce the members of our group. First, Nurul Nuraisha. Second, Fatine Aisyah. Third, Liana Shafika, Nurul Huda and Nurul Anis.
Firstly, we will talk about 1.0 ratios of Enron scandal. Enron Corporation was an American energy, commodities, and services company that gained fame for its rapid growth and impressive stock performance. Enron Corporation headquarters in Houston, Texas. This company was led by Kenny Lay and developed in 1985 through a merger between Houston Natural Gas and Internor. Enron Corporation rapidly expanded and became a major force in the energy industry. Its stock price soared throughout the 1990s and made it a highly successful company during that year. Before it went bankrupt, Enron employed approximately has 2,600 staff and claimed revenues of nearly $101 million in 2000. Audit quality refers to the extent to which an audit is conducted in accordance with established standards and best practices, ensuring that the financial statements present a true and fair view of financial positions. It is about ensuring the auditor achieve their objective of obtaining reasonable assurance that the financial statements are free from material misstatements. Audit quality is important because to gain investor trust, reduce material misstatements, complies with regulation and market stability. Besides that, auditor liability refers to the potential legal responsibility of an auditor for action or omissions during an audit. It is potentially leading to financial penalties or even criminal charge. The Enron scandal was an accounting scandal sparked by the Enron Corporation filing for bankruptcy after the news of widespread internal fraud became public in October 2001 and the dissolution of Arthur Andersen. The Enron scandal was one of the most infamous corporate accounting frauds in American history and led to the spectacular downfall of the energy trading giant Enron Corporation during that year. It exposed widespread deception and unethical practices that had a profound impact on corporate governance, accounting standards, and investor confidence.
Next, 1.4 notable strategies. Enron used unethical financial tactics to hide its true financial state. One of the main strategies was setting up special purpose entities or SPEs to keep debt and failing assets off the books, making the company look healthier than it was. They also used mark-to-market accounting, which falsely reported future profit as current earnings. Employees were threatened or fired if they spoke up, creating a toxic environment that allowed the fraud to continues for years. For 1.5 independent auditor of the company, Enron's independent auditor Arthur Andersen failed in his duty. The firm provided both auditing and consulting services, creating a conflict of interest. Worse, it destroyed important documents during the investigation, leading to its own downfall after being charged with obstructing justice. To summarize, in 2001, Enron collapsed into bankruptcy, and public trust in corporate reporting plummeted. This scandal led to the introduction of the Sarbanes-Oxley Act, which aimed to restore investor confidence and strengthen auditing standards.
Okay, for this part, I will go through 2.0, which is expand. This section highlights the key figures involved in the scandal. First, for 2.1, element impact on Enron scandal. Enron's main problem was a lack of honesty. Top leaders secretly sold stock, hurting financial trust. A big issue was the clash of interest with auditor Arthur Andersen, who both checked books and advised, making fair checks difficult. Enron also used serious fact accounting. They used market-to-market accounting and special purpose entities to inflate profits and hide debt, hiding the true financial health. Second, for 2.2, element impact on auditor liability. The scandal hugely impact auditor responsibility, especially Arthur Andersen. The audit failures were clear, which is they didn't question bad accounting and shredded documents, ruining their trust. Arthur Andersen also failed to fix basic accounting rule violation. The clash of interest stopped them from doing their job well. Lastly, for 2.3, element impacts on company financial statement. Regarding the impact on company financial reports, Enron's report contained misleading money information. They show earnings that were too high but hid huge debts, tricking investors. This ultimately lead to a complete breakdown of company leadership. Enron's culture reward bad behavior, making financial reports dishonest and unreliable.
In the case of Enron scandal, there are some factors that caused Enron scandal. First, economic bond and conflicts of interest. They were unable to challenge the company conduct because of the financial state in Enron testified about Kosati brought in more money than auditing did. Second, dual role as internal and external control, which is there was no strong system in place to detect mistake or fraud due to the lack of a functional internal audit department. The acceptance of high-risk accounting practice. Because of this practice, Enron looked to be more successful than it actually was. And the last is Ether Edison does not use professional skepticism in spite of obvious proof of financial illegal activity. There are implications. Ether Edison was unreliable due to their compromised independence as they made money from audit service than auditing. Ether established a conflict of interest by serving as both as internal and external auditor, which weaken internal control. Higher accounting principles are necessary since Enron cover their debt. Their choice to throw the audit papers and the failure to look at early warning.
Now, let's move into the recommendations to ensure audit quality and reduce auditor liability. Firstly, we recommend enhancing auditor skepticism. This mindset involves questioning information, wary observation, deep reviews, and suspension of belief. To support this, auditors should regularly receive training to strengthen their professional skepticism. To strengthen auditor independence, we propose mandatory rotation of audit partners and limits on long-term auditor-client relationship. This helps prevent over-familiarity and ensure auditors remain impartial. Finally, we must foster a strong ethical culture within audit firms. Ethic training programs help remind workers the rules, norms, and the values of ethical decision making while highlighting the consequence of unethical behavior. To conclude, Enron's 2001 collapse highlights the severe consequence of unethical behavior and lack of transparency. Through tactics like special purpose entities and mark-to-market accounting, Enron misled investors and regulators, leading to one of the biggest corporate scandals in history. This case underscores the need to enhance auditor skepticism, strengthen independence, and promote an ethical culture within audit firms to restore trust in financial reporting. Thank you.